Welcome to the Investing Mastermind Podcast. I am Signe Lundholt.
And I'm Michelle Markey.
Last time we started discussing the 2022 Berkshire Hathaway annual letter, a letter that Warren Buffett writes every year in connection to the company's annual results. And if you want to hear the discussion from the beginning, go back and listen to the last episode, or you can listen to that later. We were discussing share repurchases. This simple way to look at a share repurchase is imagine that you work in an office with 8 cubicles and the office space represents the company and each cubicle represents the shares. You have 1 cubicle, 1 share, and the CEO decides to buy back 2 shares. Now there's only 6 shares left, 6 office spaces. For this analogy, imagine that 2 cubicles were removed, so your office space just got bigger. The floor space in your cubicle is now bigger because 2 cubicles were removed. So each time the CEO decides to buy back a share, the space of your cubicle gets bigger. And we really like that. Michelle, I'm going to throw the ball over to you.
So like we said, let's touch on a little bit more on our share repurchase discussion. I know last time, Signe, you were talking about how the share repurchases that Berkshire, American Express, and Apple have done have been value increasing in that, like you were saying with the cubicle analogy, your share of ownership increased in a good way. So when some of those companies did that last year, when it's high quality companies doing it, it's pretty good. But the only thing that I call into question a little bit is, were these shares really on sale? Because 2022 at times was still sort of at the top of the market, even though it started going down. So it makes me wonder if some of these CEOs like Tim Cook at Apple or Buffett at Berkshire, if they felt it was okay to buy back their shares at only a 10 to 20% discount. So that makes me wonder how much of it really is on sale. And even though, who am I to kind of call into question these famous and really well-respected CEOs, but it just makes me wonder, what we've been taught as Buffett-style investors is that we should only buy wonderful businesses at ideally either wonderful or fair prices. So were they buying back shares at what would be considered fair prices? And sometimes it was a little bit at the top of the market, and maybe that's still at a discount in their mind to whatever their shares should be worth. So who knows, hopefully they made the right call in there. But I did notice that Berkshire did way less share repurchases than compared to 2020 and 2021. So maybe they realized that Berkshire was getting pretty close to intrinsic value. And then the only other comment I had about repurchases was, in this section, he talks about how some people are making it seem like all share buybacks are really bad. And some people might believe that because oftentimes there are CEOs who will buy back shares at any price, like even when the share price is really overvalued. And that would be like taking the hard-earned cash that the company earned and going into a parking lot and setting it on fire, like one favorite investor of ours, Phil Town, has often said. So there are some politicians or other people who like to talk, whom Buffett refers to as being either economically illiterate or a silver-tongued demagogue, which he's basically referring to politicians who like to appeal to people who may not really know better. So if you just get told by certain people in the news that share buybacks are bad because that means that the value of shares could be going down, and maybe you as a worker or just an everyday person, you're kind of suffering because companies are kind of just using up their money, it could make you think that share buybacks are not so good. And that's why some politicians want to charge an additional tax, I think of something like 1% if companies do share buybacks. But if companies do share buybacks at a discount to what the company is really worth, then it's a good thing. But if they do it when it's not on sale at all, then that's a bad thing. And that's why some of these talking people have a valid point, but it doesn't apply across the board. So that's where it can get a little tricky with repurchases.
what Buffett says is that if you have an auto dealership and it's 3 fully informed shareholders that own that auto dealership and who manages that business, and then one of these owners wants to sell his share of the company back to the 2 other owners, and he does that at an attractive price, then why is that bad? Who doesn't that benefit, right? And that's why we're saying, well, when share purchases happen in a good way, there's really no reason why it's bad. There are some, like you say, situations where share buybacks might not be a good thing, where you as an investor needs to just be warned a little bit, because there are times where some management have repurchased shares of the company to make the stock price go up and make it seem like the business was doing well because the stock price was going up. It inflates the earnings per share. An example could be that a CEO buys back the shares of the company to increase the stock price, and then that result in some speculators buying the stock in the hopes that the momentum of the increased stock price will continue. And in that way, they manipulate the individual investors. We need to watch out for that. But when share repurchases happen as a good thing, where the shares are being bought back and we get a bigger part of the company, it's a really, really good thing.
Mm-hmm.
In my opinion, it actually leads a little bit to another section in the annual report. It's a section where he's talking about the operating earnings and reporters and analysts that embraces some manipulation by managers. And we spoke a little bit about it last time, but in that section where Buffett talks about operating earnings and these manipulations by managers, what he says is that, the perception is that they're sophisticated CEOs. What we've seen is that during this time of inflation, some managers have said to analysts or reporters that they're experiencing some headwinds because of inflation. And then the analysts report that and they downgrade the company in the reports because of what management said, that they were really struggling because of inflation. But then once the quarterly earning comes out, they're actually better than the analyst had thought because of that communication from management. So the new headline is the company beat the expectations. And that's what Buffett is referring to here, is that when management kind of deceives analyst, then it gives the headlines of the quarterly expectations have been beat, and that makes people buy into the shares. So what Buffett says is that it requires no talent to manipulate numbers, but that the personal traits of these CEO is a desire to deceive. And it reminds me of something that he said in the past, how we can spot good management, because we want management with integrity, intelligence, and energy. And he highlighted that integrity is the key trait, because a person with a lot of energy and high intelligence is a very dangerous cocktail and can cause a lot of damage. And I believe that lately we've seen some of that behavior in the crypto world.
Mm-hmm. Yeah. And even talks about some of that manipulation in that same section of one CEO described it as bold, imaginative accounting in his deception, where like Buffett was totally disgusted by that kind of activity. It just goes to show that if a CEO's doing share repurchases, maybe to pump up the price so that he can get his stock options, like by fulfilling a certain threshold of the stock price, maybe that's benefiting the CEO's pocket. So we're not saying that all CEOs do this, but there might be some unscrupulous CEOs that are in it just for themselves. And I think Phil Town has described some of these CEOs as like mercenary CEOs, like they're not truly invested in the company like other shareholders. They're just, there to make a buck. And so, we have to discern which are the good CEOs from the ones who are more selfish, let's say. So that's a good segue into part of a section that was a little bit before the repurchase section, but where we said we'd continue from last time in the past year in brief section, where much to what you were just talking about, Signe, with operating earnings, here Buffett said that they're usually calculated from the generally accepted accounting principles, also known as GAAP. And then I think in 2018, the new regulation went into place that said that companies that have securities and equity holdings, that they need to include the capital gains or losses in the income. And so Buffett really disagrees with this because he feels like the wild fluctuations in the market are not truly reflective of how Berkshire is really performing. So he feels like these GAAP earnings are 100% misleading when viewed quarterly or even annually. And so even though capital gains are hugely important to Berkshire because, they have a cumulative effect over decades, but when you look at them in short periods of time, they're not that useful because he said that Berkshire actually set a record of $30.8 billion if you look at their income excluding the GAAP capital gains losses. So if you just think about that, their operating earnings that they like were actually much better. And so he's just sort of, kind of hoping that shareholders will realize what Berkshire's true performance really is. And to your point again, like depending on what some CEOs want to do, they could even distort operating earnings still. Like Berkshire is doing everything by the book and doing everything in the most honorable way. So they have nothing really to worry about. But some companies might inflate or deflate operating earnings to beat those quarterly analyst expectations, like you said, or to not beat them, depending on, what's sort of being expected there. So they might increase revenues or decrease revenues or increase or decrease the quarterly expenses depending on what they want the earnings to look like in that given quarter. So you can see that by, let's say, we talked about this offline, but if some companies wanted to have accounts payable or receivable look better or worse, they might, move some of those set, income for this quarter, or they might delay it to the next quarter, depending on when they want it to show up. So that's how some managements can manipulate the operating earnings. So, I think it's a very important lesson that Buffett is reiterating here.
In the 2017 and 18 letter, Buffett describes the new rule, and he really does not like that rule. He believes it to be not sensible. And he says that it simply just creates these waves from quarter to quarter, where one quarter it looks good and one quarter it can look bad. And he's really, really against this new rule. So his advice to us is to focus on the operating earnings.
Yeah, absolutely. And now moving on to the section of 58 years and a few figures, Buffett talked about how back in 1965, Berkshire was once a one-trick pony because all they did was do textile manufacturing, which was a doomed operation. And again, he mentions death and saying that business was on a death march. And so he was able to recognize that national indemnity insurance became available in 1967. So he started reallocating money away from textile business and toward insurance. And that began why Berkshire was able to pivot from this dying business to something that was able to lead to more cash flow coming into Berkshire. And even though he's still critical of himself, that he was slow to recognize the textile mills problems, but it's still good that he reconciled his mistake by reallocating capital. So he kind of just goes down memory lane a little bit of how 2023 was a little bit of a bumpy road, of how they are looking at the continuous savings of the Berkshire owners. So it's interesting that he's emphasizing the savings of individuals again. And also he's saying that, shareholders are retaining their earnings in Berkshire through the power of compounding. And in spite of whatever mistakes Buffett may have made, he said that most of all, Berkshire has benefited from the American tailwind, in that America would have been fine without Berkshire, but Berkshire could not have been as successful if they were not based in America. So he's super thankful about all the success that America has blessed upon Berkshire. And he kind of compares Berkshire to some of the S&P 500 companies, and he's saying that Berkshire owned 8 of some of those giant companies in the S&P 500, of how mighty Berkshire really is. And so I think there's a lot to be impressed with how Berkshire is a big representation of America. Like you could kind of think of this conglomerate as representing some things that a lot of us use all the time. If we use an HP computer, or if we get gasoline at Chevron, or we bank at Bank of America, or use our American Express credit card, a lot of ways we are using things every day that Berkshire is a part of in some way, whether they own some of these companies in part or in whole. It's also part of a lot of Americans' lives. And he emphasized again that Berkshire will always hold a lot of cash. And he also made a hint to the future of who will take over in the CEO role. And he said that Berkshire CEO will always be the chief risk officer, which is interesting to me because he's talked about the subsidiary CEO sometimes, but he's never really talked that much about the future main successor CEO to him and who it might be in the future. So he said it's irresponsible to delegate risk to someone else. So I think he's kind of saying that whoever the future CEO is going to have to be really good at capital allocation and be as good as Buffett, if not better. So he emphasized at the end of this section again that their shareholders will keep saving and prospering by Berkshire retaining earnings. So yeah, I mean, it's amazing how much, that's very important, that I think he's giving like a subliminal message to the future CEO of like, you better keep up expectations and the company culture.
Yeah, absolutely. A little bit of pressure there. I saw that one too. So before we end the show for today, we need to just talk about the last section about taxes.
Mm.
And Buffett speaks about the huge imbalance between what the United States received in taxes versus what the country spent. And if you imagine that taxes is like your paycheck, you receive $32, but you've spent $43. And that's basically just in trillions what has happened in the United States. So when you do that, you overspend your budget. And Buffett says, well, I don't try to forecast what the consequences is of this huge imbalance that the United States have. He focuses on managing Berkshire Hathaway, and what he writes is that he has prepared the business for any potential worldwide recession or anything that should occur in the future. And we can learn from this too. So instead of necessarily for us as investors focus on macroeconomics, the global economy, etc., we as investors, we must focus on finding individual quality companies to invest in. And the company's competitive advantage is very important here. Warren Buffett, he calls the competitive advantage a moat. And you can go back and listen to one of our previous episodes where we talk about moat to learn more about that concept. What I think was super interesting in this section is that Berkshire Hathaway, they paid $32 billion in taxes. And if 32 trillion was collected in taxes, then the company paid 1/10% of what the Treasury collected. And what Buffett says is that if 1,000 taxpayers in the US would match Berkshire's 32 billion contribution, then no other household in the US would have to pay a dime in taxes. So that would be all the large corporations in the United States, and then the country would be golden. It's really food for thought, because then no other taxpayers would have to pay tax. Buffett, what he says is that he hope and expect to pay much more in taxes during the next decade. And we can also see that Biden, he wants to increase the corporate tax from 21% to 28%.
Yeah, as we've learned from Laura Rittenhouse, it speaks to how much candor Buffett has in saying that they expect and hope that they will pay more taxes in the next decade. And so it's kind of funny that he says that anyone who works at Berkshire or owns Berkshire says, I gave at the office, which means you did your civic duty of paying all the taxes you owe the government. And I think Buffett is throwing some shade on some companies that try to do everything they can to pay as little taxes as they can. But Berkshire seems to be, just taking it on the chin of like, whatever taxes we owe, we are up for it. That's how you can get to a place where you're kind of paying like say the government's bills for say half a day or whatever. I think Buffett once wrote about and saying that the 32 billion that they contributed in taxes was the 10th of a 1% of the Treasury's income collection. So it's kind of funny how big that portion really is from Berkshire. And I think getting close to some final thoughts we had. I know Signe, you had something super nice to say about the section "Nothing Beats Having a Great Partner" last time. And I think it's just super wonderful how Buffett included these really awesome quotes from Charlie. And I just wanted to share a couple that I like. The ones that really resonated with me of Charlie quotes was Charlie had said, "You have to keep learning if you want to become a great investor. When the world changes, you must change." And Buffett also quoted Charlie in saying if Warren had some dilemmas in trying to make decisions, sometimes Charlie would say, "Warren, think more about it. You're smart and I'm right." And so I think it's just amazing how much Warren honors his best friend and business partner, Charlie, like that. And I don't know if he's ever shared so much, but I feel like maybe Buffett's getting a little bit worried about Charlie being 99 years old. So he wanted to remember Charlie in this way of like dedicating more than a page to all of Charlie's wisdom. And I think it's such an amazing thing, the amazing partnership that they've had over the years. And Berkshire also wouldn't have turned out to be what it is without Charlie. So I think that's an amazing tribute to him.
Lots of amazing quotes and wisdom coming from Charlie Munger. So I want to end with, for you as an investor, I can really recommend reading the letters and reading about Warren Buffett's principles in these letters. Everything is there about his investing style and strategy. By reading these letters, you can invest by him and use his framework. And what Michelle and I were trying to do with this podcast is, we've taken all the information we've read over the years, everything we've read in books by other authors that are also Warren Buffett style investors, and then we connect the dots and find the patterns, and then we share the information with you guys. We also, we take what he says and then we use language of today to translate what he's saying, because sometimes it can be a little bit tough. But I really hope you got a lot out of this episode and us walking through the letter.
Yeah, and don't forget, one last little bit that Warren made sure to mention is find a very smart, high-grade partner, preferably slightly older than you, and then listen very carefully to what he says. So to your point, Signe, find that either in your actual friends or through other super investors or authors we admire and respect. And, even if you don't know them so directly, they will help guide you along to be a successful investor.
That's it for today. We'll be back on Tuesday.
Yeah, till next time.
If you enjoyed the show and found the content informational, we would be super grateful if you would leave us a review and follow us wherever you get your podcasts so you automatically get new episodes in your feed. We publish a new show every Tuesday.
The contents of the Investing Mastermind podcast are for educational, informational, and entertainment purposes only. None of this is investing advice, and if you need help in your personal situation, please consult with a professional.